Hello and welcome to yet another live session. If you are all ready for this live session, just type ready in the comment box. And in today's session, what I'm going to tell you is how you can profit from any kind of market condition, whether it is a bull market or bear market, how you can actually benefit from that. That is what we are going to discuss in this particular session. So let's begin and let's go for this. Awesome. So today's topic is around how to play the sector rotation and what are different elements of sector rotation. Okay. So we'll go step by step. I have a detailed mind map and we are going to go much deeper into this topic. So take a lot of notes as usual and this will be amazing session as usual. Okay. So let's dive into the three components why we need to study this particular element, right? So if you think about it, the first thing why we need to understand any particular sector for that matter is because investing is a game of probability. We want to have odds in our favor, right? So to do that, we need to understand how this entire thing operates and how investing actually works. Okay, then only we can take maximum advantage of this entire thing. Are you clear with this? So that is the first point in which we need to understand how we can have odds in our favor. Now, once we understand which sector plays at what time, you can actually build a framework around this and you can actually take advantage by doing that rotation in a timely manner. So that is the second thing, you maximize your returns. And the third thing, which is very important, is to avoid getting killed in a bad phase when the things are not working in our favor, right? So these are the three important things why we are doing this entire exercise, so that you can make maximum in your bull market, you can minimize your losses in the bear market and manage your risk, and you can always have odds in your favor, because that is the ultimate objective being an investor, and that is what we all are going to dig deeper today in this session. Okay, so let's first understand the basic principle, right? Why should we understand the cycle? All of you might have this question, right? Ki cycle samajhna kyun hai? So that is the reason I'll tell you why we need to understand this cycle first. Okay. So let's go to the presentation and let's check it out. What does Howard Marks says about understanding the market cycle, right? He has popularly written a book which is called Mastering the Market Cycle. And he clearly says that the odds change as our position in the cycles changes. Bottom of the cycle and you are entering, your risk reward might be much more favorable. If we don't change our investment stance as these things change, we are being passive regarding cycles. In other words, we are ignoring the chance we are being provided to tilt odds in our favor. But if we apply some insights regarding the cycles, we can increase our bets. Like you can increase your allocation, you can actually bet more when the risk reward is in your favor, and when you understand that the cycle which you are playing is in your favor, and place them on more aggressive investment when the odds are in your favor, and you can make maximum return, and we can take money off the table and increase our defensiveness when the odds are against us. That is what happens, right? If there is a bear market, you will not play cyclical or metal companies and all those things. You will try to protect your capital and you will move towards the cycle or the sector where the odds are much more in your favor. If you are clear so far, just type clear in the comment box, because this is the building block of what we are trying to understand in today's session. That is the first point. Now let's try to understand the second very important point, which is business and economic cycle. What do we mean by business and economic cycle and how we can make sense around it, right? So the first part is economy cycle. We have a lot of cycles where we need to understand what is the overall economics around things, right? And second is your business cycle. Like we need to understand how to understand how business are behaving, right? So let's first understand economy cycle. Okay, so this is like the kind of cycle which we have all known through, right? There is an expansion of the economy, people are gung-ho about buying things, and then there is peak of the things, then again there is a recession and contraction, lot of buying goes down, and then again there is a bottom which is getting formed, and ultimately then again the growth starts, right? So that is what the overall cycle is, which we all know. Now let's try and understand why these cycles occur and what are different components, right? So these are 4 components: expansion, where the economy is rising and you are making a lot of money, economy is making a lot of money, GDP is increasing. Then you have peak of the economy, then you have contraction where growth is tapering and you might also go into recession, and there is a bottom of that cycle, and then it again picks up. This is like a normal cycle for each and every business. Now let's try to understand a very, very important point. You might say, Vivek, why do they occur? Why don't things remain in a steady state? Why there is a cycle which happens, right? That is a very, very important point to know. Now the cycle happens because of one very prominent reason. And this is what again has been talked by Howard Marks in his book. He says very few things move in a straight line. There is a progress and there is a deterioration. Right? Things go well for a while. You might have अच्छे दिन for a while, and then it can go poorly, right? And that happens in our life also, right? कभी mood किया, we'll go for gym and all that, and then something happens and we are not even doing anything. And same way, we get a lot of motivation and फिर बाद में the motivation goes down. Even in this video, it might happen. A lot of people might take notes initially, and then that learning mindset might go, and they might again go to Netflix. And they will not focus on learning, and some might be consistently watching and they might be taking notes, right? So things are cyclical, and deterioration may creep up gradually and then turn climatic, so slowly that thing will happen, and then eventually, the force will be much higher. But the underlying principle is that things will wax and wane, grow and decline. The same is true for economics, same is true for markets, same is true for companies. They rise and fall. This is what Howard Marks has written in his book. Very, very prominent statement. Now let's try to understand from our consumption side of things, and that is where you will be able to understand sector rotation in a much deeper way when we talk about it, right? So when things are optimistic, what we do? Like everything is hunky-dory, we have a job in place, the salary is increasing, everything is awesome. What we do? We spend more, we probably borrow more, we consume more. And because of that, what will happen? Inflation will increase and interest rates will also rise, right? So to understand this entire sequence, it is very, very important to understand our consumption sequence, right? So once you understand the consumption sequence, that is where it will be magical. So basically what happens is we start going to restaurant, we basically start eating good food, right? If you think about it, we start eating good food when we are having some good times. And what happens next? Just type in the comment box. So first we try to eat good food, then we probably go out in restaurant, watch movies, and there it could be your utensils, your microwave, it could be your refrigerator. All these things simultaneously happen. And then what happens? We probably buy a property and spend even more if we are confident about the economy. Yes or no? Right? So that is what all of us do when things are moving in our favor. And if you think about it, what will happen eventually because of this? What will happen because of this? Just think about it. If we consume more, if more refrigerators are built, more real estates are built, houses are built, what will happen? Eventually the cycle of consumption will increase. All the underlying raw materials which are there, that will also start going up, right? So that is where the consumption picks up. Okay, the consumption picks up, and that is what is I'm showing over here. Just see what is the sequence. I'm able to load this sequence. So you can see here that initially, we are consuming better things. We are getting better food. We are partying, and probably, we are also eating out in restaurants. That is like the sequence that goes. And then we are probably buying all these refrigerators and fancy things. And then probably we are going out in holidays. And then we are probably buying out some mortgage and home loans and all those things. So is it super clear? Like this is like the sequence in which it grows. That results into, just give me a second. Okay. So that results into more and more inflation, right? The kind of money that is going on, the prices will increase, and then government or RBI will think, if it is whatever central bank is there, they will rise the interest rates, right? That okay, now too many people are buying too many things, now inflation is not in our control, and let's increase the interest rate. Now when things are bad, when everyone thinks pessimistic about the future, that aage kuch nahi hone wala hai, my job might go off, the recession will be there, what they will start doing is they will start borrowing less, they will start consuming less, inflation will decrease, and the interest rate will be lowered. Right? So this is like the classic cycle from the consumer point of view. And once you know this cycle, you will also be able to understand which sector to focus on and where to rotate in the different cycles of the entire economy. Is it clear so far? Just type super clear in the comment box. And there are a couple of books which are very, very useful. I've shared the link in the description also if you want to check it out. One is with Mastering the Market Cycle by Howard Marks. That is a very powerful book. Second is Capital Returns, where you will find a lot of insights on. And the third book, which I have written, just getting out very soon, which is called You Can Compound. If you are watching this recording in June, probably, you might have this copy out as well. Okay. And if you want to go deeper and understand, things from your surrounding and how to understand why people are buying real estate, why people are buying this, you can actually go and look at this video which I have created, which is called Investing Lessons from Peter Lynch. So this is where also you'll get a lot of insights. Okay. Now, fourth point which you need to understand is supply side dynamics. If you are able to understand the supply side of the things, then you can spot these cycles very, very quickly. Okay. So that is where you need to understand how management is able to understand the entire business cycle, how they are able to think in advance, how they are creating capacity in advance, how they are not taking too much debt so that when cycle turns, they can put money into balance sheet money into creating capacity. And that is where you should check out the capacity to suffer of a management. That is where you will get so many multi-baggers, companies which has strong management who understands the business cycle, and they get into that sector much quicker, and they put supply upfront. Right? So imagine a scenario, right? If there is a hotel industry and there are so many tourist destination where tourists are not coming yet. Okay, so we are in the downward cycle, and there is a promoter who is very shrewd, and he has maintained a strong balance sheet, and he understands the entire business cycle, and he knows probably in next 6 months to 12 months or 2 years the demand will pick up, and he starts building a new hotel and starts putting that supply. Now other players might be too leveraged because it's a downward cycle, and they might not be able to put up the capacity. And that's where, if you understand management and how they take action and whether they understand business cycle, you can get benefited in a cycle in a huge way, and it can give you multi-bagger returns, right? And same goes for us, right? When things are bad, a lot of people, are struggling and they take a lot of debt. But if you are really shrewd and if you really are disciplined in your investing journey, you will not take too much of debt when things are all hunky-dory. You will save for the, rainy days. And that trait is very, very important. And you need to save when the things are good. You don't need to have that mindset when things are turning bad. Then you cannot do anything, right? So I've covered this entire concept, how to budget your, savings, how you can invest those savings. I've also shared a detailed template around it, which you can download for free. And you can actually start maintaining your budget and save and invest right now, not wait for a recession or when things are going bad. Okay, so that's a very, very important trait. And a lot of people also don't have emergency fund. So like for companies, they go bankrupt in bad times and they are not able to survive and, take advantage of the upcycle. That same thing happens for individuals also. And that is where you need to also be focused fully on your personal finance, maintain some kind of 6 months to 12 months emergency fund, have your insurance in place and all those things. Again, I'm not going deeper into this, but if you want to go deeper, there is a video which I've done long time back, which is called 10 Powerful Personal Finance Principles. And these are very, very serious and important principles which you should follow. I thought just I'll tell you because it is also cycle which we are playing, right? If you are not able to save money in the down cycle, how will you invest in the companies in the down cycle and take advantage of it? It goes hand in hand. It's not like companies, you understand the management, you understand the business cycle and they are doing good, but then you don't have money to invest at that point of time. right? So capital cycle is very important to understand from the management's perspective and business perspective, and it is also very important to maintain that from our angle also, right? And there is this entire business cycle which is shared in this book, Capital Returns. So what happens is, this is from the perspective of capital owners, right? So this is like from the perspective of capital owners, what happens? So from the perspective of capital owners, they want to deploy money when the returns are good, the potential of the things are good, and they will remove the capital from an industry when things are not moving fine. So if you go to the top orange quadrant, you see that new entrants are attracted by a sector where there are high returns possible. So all the investors are optimistic about that sector, about that industry. Then what will happen, because it is so much a profitable sector, a lot of other players will start coming in. So the competition will rise. Okay. And the returns will fall below cost of capital. And that's where the share price of that company or industry will also underperform. Now that is where, a lot of business, new money will not come in. The industry will go under consolidation. A lot of firms will exit because they are not making money. And that is where the point of pessimism is. And that's where I was saying that if you are able to find a management who is able to understand this entire cycle, okay, the supply side of the things, then they can make a lot of money out of this cycle. Okay. So if somebody is putting capacity there in the worst of the things and they have a strong balance sheet, they can take advantage when the improvement happens on the supply side. And the returns are then rising about cost of capital, and then they'll make a lot of money. If you are investing in those kind of companies at that point of time, you will also make a lot of money. And this entire cycle continues, right? So if you are able to understand this entire big picture of how the capital cycle works, just type clear in the comment box, and you can get a lot of clues from the annual report also. Like if once you read annual report, if you see the past cycles and see when they have done capex and whether it was in the bottom of the entire capital cycle or whether it was at a peak when everyone was doing it and then they undergo a lot of debt and go bankrupt, you will know the traits of the management, how capable is the management and how is the capital allocation decision made by the company. Okay, so I've done again a detailed video on what all sections you should read for annual report, but this is what you need to keep in mind. Okay, now let's do a deep dive in terms of sector rotation. By the way, if you are not yet subscribed to this YouTube channel, please do it. I share a lot of these kind of awesome videos and I discuss a lot of serious stuff on investing as well as in a very, very simple way. So if you are not yet subscribed, please hit that like button, share it with your friends if you liked it, and also subscribe to this channel. Okay, just a call to action. Because YouTube likes it, right? If you hit a thumbs up button, YouTube thinks that, okay, I'm giving a lot of powerful stuff, and it makes it more reachable to other investors also. Now let's go deep dive and understand the sector, dynamics. Now this is a very, very powerful, diagram which you need to understand. So if you see the red, circle which is there on the top, that is a market cycle. Okay, stock market cycle, like bull market, then you have market top, and then you have bear market, and then you have late bear market. And the blue color line which you see, that is your business or economy cycle. So there is, if you see the bottom, there is a return, full recession, then there is a early recovery, and then there is a full recovery. So if you see, when there is a recession, full recession going on, the bull market actually gets started. Okay, so you need to understand that market is a leading indicator. Stock market is a leading indicator. It starts much before the economy shows the sign. Okay. Now, what is the first thing that picks up? Now all the things which we shared earlier will connect back. Okay. So we discussed that people start consuming more, people start borrowing more, and they'll start taking credit. Now you see this diagram, you will understand that finance and technology and all these cyclical companies will start moving first from the market bottom. Then you will have industrial and basic materials. Why there is industrial and basic material that will start? We have again discussed this into this video, right? So we have discussed that once people start partying, they go to restaurant, they buy things, right? So once they buy things, it could be their utensils, it could be a refrigerator, it could be new AC, whatever it's there, it will start consuming a lot of underlying things. And that is where all these industrial companies will start picking up. Okay, and later on all these energy consumption and all those things will increase, so the energy companies will pick up. So at the market top, all these companies will also form a top. Now when market starts declining, what will happen? Again the same cycle, right? So people will consume less, they will borrow less. So you need to stay away from finance and high consumer durables, non-discretionary consumer durables particularly. And where they will hide, basically think about it. What is the basic necessity? Even if you are in a recession, you need roti, kapda, healthcare and all those things, and utilities, right? So that is where in the bear market, all the investor will rotate into the sectors like utilities. They will rotate into the consumption or FMCG kind of companies. They will rotate their money into healthcare and all those kind of companies. So you need to keep it in mind that you are not caught at a wrong end of the cycle, right? What will happen if you don't understand this sector rotation? What will happen? The thing will be simple, right? You will basically go into a wrong thing. What will happen is, if you are at the top and you start buying metals on the peak of the bull market, what will happen? You will get butchered. Like when it falls, it will be no tomorrow. Okay. And again, I want to give you example also of how this stock market is a leading indicator, right? So I'll just give you an example of Zoom. All of you might be knowing what happened during COVID, right? So during the COVID fall, all the things were going down, all the industrials and all those companies, metals and everything was going down. But this is a chart of Zoom. You see, even before March 2020, Zoom started going up. So what does it indicate? That people are anticipating that lot people will start using Zoom as a service because the COVID will keep going on, right? And this is a very powerful concept called stage analysis. And in our, mastermind, where I do my inner circle with my community and also hackathon with my investment community, I actually do this topic as a stage analysis. And if you understand this, you can play any cycle because it happens again and again in front of us and it keeps repeating. And those who don't understand, you see the right hand side part when it is declining. There again, if you see September 2020 market anticipated that the COVID will go off and the stock price started falling. So market is always a leading indicator, and that is where the fundamentals will come much later. And that's what we also understood in this particular diagram, right? So the economic recovery will happen much later, but the market, bull market will start much earlier. The recession will come much later, but the market top will form much before that. And that is where you need to understand the price volume action, the technical analysis also. Because if you don't understand that, you will see fundamental and you will say, oh, Vivek, everything is going fine. Why should I get worried about it, right? You might have seen a lot of people telling, that, oh, fundamentals are great. I don't know why this is falling. So that is this reason because of which it is falling. The market is a leading indicator. So if you are with me so far and you are clear so far, just type with you in the comment box. Okay. I want to make you understand all these connecting dots before even still going deep dive. We are still going to go deep dive in terms of what to take in terms of action and when to take it. Okay. So I'm going to go much deeper, still 10 more minutes to go, but hope you are understanding all these principles which we are talking right now. Okay. Now next, let's come to the very important principle which is called mean reversion. So most of the companies are cyclical. Even in my book, I have a dedicated chapter which I mentioned to all of you that you need to understand cycles, and that is where you will get a lot of powerful insights, right? So even in my book, I have covered this entire chapter which is on how to play cyclicals, what are stages and how the stage analysis affect the companies with a lot of case studies. Even this Zoom case study I have placed in my book also. Okay. So most of the companies are mean reverting. So if you play a mean reverting with a buy and hold strategy, what will happen? When this upcycle is there, you will make money. Probably if you are prudent, you will add capital also, but in the down cycle, you will give out all your gains. Okay, you will give out all the gains. So that typically happens in these kind of companies. So if you see, there are mean reverting companies which are like metal, agro, sugar and tea are more like a mean reverting companies. Then there are companies which are strong compounding companies which go in a long-term upward trends. And then there are very bad companies which keep on going in a downward trend. So these are the three kind of companies. Now you need to first understand the business model and the cycle of that company even before deciding whether you are going to do buy and hold or you are going to, book profit at some point in time in the sector. Okay. So that is where the mean reversion principle comes in. And most of the mean reverting companies you should be playing in the satellite portfolio. If you don't know about it, you can later on watch one of the video I've created, how to outperform Nifty returns, and there I've covered in detail what is this satellite portfolio, what is core portfolio, which kind of sector you play there, which kind of sector you play in core portfolio. Now there are some companies which defy mean reversion. What are these kind of companies? These are the companies which has strong competitive advantage. Okay, they have big opportunity size. The sector itself is compounding. They are monopoly in the industry. There are underlying mega trends which is pushing that growth for a long period of time. So when you have these mega trends in place, and most of the times you also have companies which are monopoly in their industry with a big opportunity size, that is where the magic will happen. And these kind of companies will defy the trend in terms of that down cycle. They will not revert to mean very quickly. Okay, and there are multiple such what we say competitive advantage which you will see in these kind of companies. And if you are able to find these kind of competitive advantage and structural mega trends, you can ride them for a long period of time. And these kind of companies should ideally form part of your core portfolio. So I did an exercise with our group. So we have a quantum mastermind, which is like the highest level in our community, where we did this exercise that if you want to find out companies which are compounding 25% every single year, what should be the trade? And then we did detailed exercise. We came out with different sectors. We came out with companies within that sector. But broadly, these were the thought process which came in our mind, that these companies should have sales growth of 10 to 15% for very long period of time to justify whether they are structurally compounding companies which can grow at least 25% every year. Right? So if you grow 25 to 26% every year, basically every 3 years you are doubling your profits, and every 10 years you are becoming 10x. And the earnings growth will reflect in the share price also. So if your earnings become 10x in 10 years, you might make 10x in 10 years. So first criteria is sales growth, which is 10 to 15%. Second is sector growth, which is around 10% plus. The sector should be growing like the fish, or the opportunity size should be much bigger, right? So it should be like a growing pot which is out there. Then you have company which is gaining market share. So it should be a scenario like a left side, small fish in a big pot, where it is able to capture market share also, and it is also able to grow in that pot. And finally, there should be big pool of unorganized players where they can also gain the market share. So this is how you can also, find out a lot of sectors and companies and make sure that you are finding and riding those companies which are defying mean reversion. Okay, those kind of companies you can actually ride for very long period of time, and there you can overlay the concept which we discussed today in terms of sector rotation. Like if it is a banking mega trend, you can actually switch to FMCG mega trend when the cycle is topping up, so that you can maximize your returns. So you can play your sector rotation by understanding the entire cycle of the sectors which I shared with you. And then finally, you understand which are the companies which are structurally very strong that could be played in your, core portfolio. Okay. So that is the big insight from my end, and hope you liked this video. We are towards the end of this video. And as I said, if you want to check it out later on, my book is coming soon. It is called You Can Compound. And if you are watching it in June, it will come very soon, and you might be able to grab it. So this is a quick update from my end, and let's recap all the points which we have discussed very quickly. So first thing which we discussed is why understanding of cycles are very important, to make most of the cycle, to maximize your probability in your favor, to exit when it is necessary. so that you protect your capital and manage your risk. That is the first thing which we discussed. The second is we understood the concept of business and economic cycle. What are the peak, trough, recession, and the accelerating phase which is there for the economic cycle. Then we understood why do they occur, right? So we understood people get jobs, they get salary, they start consuming, they start taking credit, and this entire cycle. Then we understood about supply side dynamics. We also saw important traits of management. What are the traits which are needed, and how a management, if they are prudent, they can take advantage of this entire capital cycle. So that is what we understood as a fourth point. Fifth point, we understood the entire sector rotation, like what are the sectors and how it rotates, and we understood this entire deep dive. Then we finally understood that stock market is leading indicator, and we also did an example of Zoom. And then finally, we understood the concept of mean reversion, and finally defying mean reversion. Yeah, so that is all from my end. Hope you liked this video and enjoyed a lot and got a lot of powerful insights in short time. Thank you so much again. Take care and have a great remaining evening. Bye-bye.